Tesla seems to have kind of forgotten the golden rule of the car industry, which is you don't stay new and exciting for very long. Tesla's had very long product cycles and has not been introducing new cars as rapidly as its competitors, especially its Chinese competitors.
The EV car market is about to collapse, and the people who seem to know it first are the dealers staring at rows of cars that are not moving. This is not about one bad month, one weak brand, or one slow showroom. The warning is showing up across American lots, where the cars once treated like the future are starting to feel much harder to sell. And that is what makes this so uncomfortable. For years, buyers were told EVs were unstoppable, the prices would fall, the charges would spread, and the switch from gasoline would move faster every year. But inside the dealership world, the mood is changing. More inventory is sitting still. More discounts are being pushed. More buyers are asking harder questions before they sign. The strange part is that dealers do not need speeches to understand trouble. They read the market through empty test drives, delayed purchases, weak trade-ins, and cars staying parked too long. So when EV dealers, buyers, prices, and unsold cars all start pointing in the same direction, question becomes serious. Is this just a slowdown? Or are dealers watching the first real crack in the EV market collapse before everyone else admits it? By Q4 2025, the first clear break was already visible on American dealer lots. New E5 sales had fallen more than 36% from a year earlier, and about 46% from the previous quarter. Market share dropped from 10.5% in Q3 to 5.8% in Q4. Cars that once moved quickly were now staying parked longer across showrooms from California to Michigan. Cox Automotive counted 216,399 EVs in Q1 2026, around 27% below Q1 2025. The next quarter reached 247,226 sales, but volume was still 20.5% lower than a year earlier. 2 weak quarters followed the first drop, which meant the market had not simply paused for one bad month. The fall was continuing across brands, prices, and major regional markets nationwide. Battery electric sales across the first half of 2026 were down 25.1%, while BFA market share lost 1.7 points. Hybrid sales moved the other way, rising 19.4%. Buyers were still looking for lower fuel costs, but many were choosing a cheaper and easier step instead of taking on the price and charging demands of a full EV during the same period. Cox Automotive's Dealer Sentiment Index fell to 38, with franchise dealers at 47 and independents at 35. Lower numbers meant weaker confidence. The cars were still arriving, but buyers were hesitating, discounts were growing, and older inventory was taking up space that dealers needed for vehicles people were still willing to buy through the final difficult weeks of that year. Unsold EVs, weaker trade-in values, larger incentives, and returning leases were now landing on dealer books together. September 2025 had looked strong, but Q4 2025 exposed the drop. The next move came from one deadline. Up to $7,500 in federal support disappeared after September the 30th. Leaving buyers and dealers to face the full price almost overnight across the entire country. The credit, the deadline, the price left behind. On September 30th, 2025, the new clean vehicle credit, used EV credit, and commercial credit all ended for vehicles acquired after that date. A qualifying new EV could lose $7,500 in support, while a used one could lose $4,000. The car stayed the same, the buyer's price did not. A record can hide what comes next. J.D. Power expected EVs to reach 12.2% of retail sales, then placed the final share near 12.9%. Buyers who planned to wait moved early, pulling future purchases into September 2025. The surge looked like growth, but part of it belonged to later months that had already been emptied before dealers reached them. 53% disappeared in the first full month without the credit. October 2025 sales dropped 53%. Retail share fell from 12.9% to 6.0%, and NADA counted BEV volume down 46.7% from September. The market had fallen off a cliff. The same vehicles remained on sale. The money helping buyers reach them was gone. 6% was still the number one month later. November 2025. EV share remained at 6.0% compared with 9.6% a year earlier. Dealers now had to replace a missing $7,500 benefit through their own deal structure. Monthly payments rose, price gaps looked wider, and hybrids suddenly felt easier for families trying to lower fuel costs. The loss was now visible on every finance sheet. Discounts replaced public support. Manufacturers turned to low-rate loans, subsidized leases, factory rebates, and dealer cash to keep EVs moving. But every new incentive came from company or dealer margins. Expensive cars were still arriving, while buyers had already moved purchases forward. That left the next problem sitting in plain sight: unsold inventory growing faster than demand. And dealers knew which number would expose the damage next: supply. 46 days of supply can make a market look healthy. That was the number after the September rush, when buyers moved early to secure the credit and dealer lots briefly emptied. September 2025, 46 days. Federal EV credit and Cox Automotive created the appearance of strong demand. But much of that demand had been pulled forward from the months that followed. 149 days told a very different story. New EV inventory had climbed far above the roughly 88 days carried by gasoline, diesel, and hybrid vehicles. 149 days, 88 days, 42% higher, and mid-2024 levels showed how quickly the balance had turned. The cars were arriving faster than buyers were taking them. Dealers could see the gap without waiting for another report. Toyota, Volkswagen, and Hyundai were among the names carrying the heaviest EV supply during that period. Toyota, Volkswagen, Hyundai, and Vorto Live Market View were no longer just numbers on a screen. They were rows of vehicles sitting longer, tying up space and money while fresh deliveries kept coming. Every extra day made the next discount harder to avoid. 4 months on a dealer lot changes the way a car is sold. Around the beginning of 2026, new EV inventory still stood near 130 days, about 73% above the year before. 130 days, 73% higher, January 2026, and 4 months meant repeated advertising, larger incentives, and more cash trapped in vehicles that could lose value before a buyer arrived. 71 days looked like relief by May, but the deeper numbers told another story. Q2 sales were still 20.5% lower than a year earlier, while factories cut output and incentives grew. 71 days, Q2 2026, 20.5% lower, and production cuts showed why inventory improved. Demand had not fully returned. The industry had simply started shrinking the problem itself. An average of $11,258 was placed on each EV in March 2026, according to J.D. Power. Gasoline, diesel, and hybrid vehicles needed about $3,030. The gap was enormous. Dealers were not simply lowering prices a little. They were using more than 3 times as much support to bring the same buyer toward an electric car. That difference showed how far the market had moved from natural pricing. A second calculation reached the same place. Cox Automotive put the March EV incentive at $7,967, equal to 14.6% of the sale price. New EV prices were already 6% lower than a year earlier. The discount was doing the selling. The car moved, but the margin behind it kept getting thinner. Each sale could look healthy from outside, while losses were absorbed inside. Another $7,640 was still being offered in April 2026, equal to 13.8% of the average transaction price. Even with that help, new EV sales fell 23.1% from the year before. The discounts slowed the fall, but they did not bring back the old growth. Buyers were still resisting the price. More money kept entering each deal, while fewer buyers came through. By May 2026, the average new EV sold for $54,532. Prices had now fallen for 11 straight months, while incentives remained near 14% of the final deal. That worked out to about $7,611 on each vehicle. The sticker price stayed high, but the amount needed to close the sale kept rising behind it. Every large discount reached beyond the new car. A 1-year-old EV or 2-year-old EV suddenly had to compete with a cheaper brand new model. The dealer might complete today's sale, but tomorrow's trade-in would be worth less. Kelley Blue Book values, lease returns, and used car prices all began falling together, exposing how few affordable EVs were actually reaching buyers. 9 EV models sat below the $40,000 line in November 2025. Across gasoline, diesel, and hybrid vehicles, buyers could choose from 56 models under the same price. Cox Automotive had now exposed the real gap. The affordable end of the market was crowded with non-EVs, while electric choices remained thin for ordinary families watching every dollar. A buyer could compare several gasoline crossovers and hybrids before finding one electric option in the same range. That difference shaped every showroom choice. Vehicles priced below $40,000 represented 38.7% of the new car market, but only 3.7% of EV sales. The model count showed the shortage. The sales mix showed how deeply it affected buyers. Most electric volumes still lived higher up the price ladder, where stronger incomes, larger down payments, or a heavily supported monthly payment were needed to make the deal feel possible. Even customers who wanted an EV often reached the finance desk and found the payment above a familiar hybrid or gasoline model. The market had grown above its buyers. A $47,000 EV could look far more reasonable when a $7,500 credit was taken off the deal. The factory cost had not changed. The car had not changed. Only the amount paid by the buyer changed. When that support disappeared after September 30th, 2025, the price gap returned all at once. A vehicle that had competed with a popular crossover one day could suddenly sit thousands of dollars above it the next. Dealers could replace some of the lost support with rebates or low-rate financing, but that money had to come from somewhere. The credit had not created affordability. It had only hidden how far the price still had to fall. Leasing became the industry's way around that problem. J.D. Power found that 46% of franchise dealer EV transactions in 2023 were leases. During the first 9 months of 2024, leases made up about 30% of EV volume when Tesla and franchise brands were counted together. Lower the payment now, deal with the value later. A lease allowed the buyer to use the car without paying its full price or carrying all the risk of future resale value. Manufacturers could support the monthly payment with incentives, while dealers moved expensive vehicles that might have been harder to sell normally. The arrangement kept demand moving, but it pushed the hardest question into the future. After 2 years or 3 years, the leased EV came back. The customer had avoided the full purchase price and much of the resale risk, but the risk had not disappeared. It had moved to the leasing company. If the predicted value was higher than the real auction price, someone had to absorb the loss. By 2026, thousands of those cars were returning to dealers at the same time. Each one had to be bought by the driver, kept by the finance company, sold at auction, or placed on a used car lot. A cheaper returned EV could attract a buyer, but it could also pull attention away from the new one beside it. The payment had been lowered years earlier. The financial pressure was arriving now. 243,000 EV leases are expected to end during 2026, according to J.D. Power. That is more than 3 times the volume from 2025. Each car must go somewhere, back to the customer, into a finance company's inventory, through auction, or onto a dealer's used lot. The return is not a forecast anymore. It is already written into signed contracts. Drivers made those deals 2 or 3 years earlier, when EV prices were higher and future values looked stronger. Now every contract is reaching the point where the original estimate must meet the real market. 5% of lease maturities were EVs in 2025. Cox Automotive expects that share to reach 12% in 2026 and nearly 23% by 2028. Even if factories slow new production today, these cars will still come back. Their return dates were fixed years earlier, which means the supply wave keeps growing after the first response from automakers. Production cuts can reduce the number of new vehicles arriving, but they cannot cancel leases already signed. The industry is dealing with two timelines at once: fewer cars being built now and more used EVs returning from the last expansion. 47% more EVs moved through Mannheim auctions in Q4 2025 than 1 year earlier. That happened before the largest return wave had even arrived. Auction sites started adding chargers, battery procedures, and trained technicians. The supply was already visible. The contracts told them how many cars were coming and when the lanes would begin filling. Each vehicle also needed a battery check, safe storage, and a buyer willing to price the remaining range and warranty correctly. Auction companies were preparing because a normal used car process was not enough for the volume and technical questions approaching. Dealer screens show the loss before the public sees it. Appraisers watch wholesale bids, receive lease maturity lists, check trade-in values, and decide which returned cars to keep. If the auction price lands below the value predicted years earlier, the difference appears immediately. 1 week bid can turn an old lease estimate into a real financial hit. A finance company may have expected the car to be worth much more at the end of the contract. When buyers refuse that number, the gap cannot be explained away. It becomes a loss, a larger discount, or another vehicle sent through auction. A 2-year-old EV or 3-year-old EV can sit beside a new model with similar range and equipment for far less money. That used car may bring a buyer into the store, but it can also make the new one harder to sell. Dealers then face another discount. By 2026, used supply was rising while new EV demand was falling, and both markets were starting to pull against each other. The cheaper return helps the customer who wants value, but it weakens the price of every similar vehicle around it. One part of the market grows while the other loses margin, leaving dealers caught between moving used cars and protecting new ones. New EV sales were expected to fall about 28% in early 2026, while used EV sales were projected to rise around 12%, according to Cox Automotive. Buyers were not rejecting electric driving at every price. They were moving toward cars with smaller payments, lower risk, and prices that no longer depended on a large federal credit to feel affordable. A buyer who could not justify a new model at full price could still accept the same basic technology after depreciation had removed thousands of dollars. The demand had not vanished. It had moved down the price ladder. The final count stayed close to that warning. New EV sales fell 27.3% in Q1 2026, then remained down 20.5% in Q2 2026. 3 straight quarters now carried serious year-over-year weakness. The decline had slowed, but dealers were still moving expensive new models with heavy incentives, while older inventory kept taking up space on their lots. Every slow sale meant more money tied up, another discount considered, and another month of carrying costs. The market was still functioning, but it was no longer moving at the pace factories had planned for. Vehicles designed for fast growth were now competing for a smaller group of buyers who expected deeper cuts before signing. Used EVs moved in the opposite direction. Cox expected about 128,000 sales in Q2 2026, up 28% from the previous quarter and the same amount from a year earlier. Sales had nearly tripled since early 2023. The cheaper car was finding the buyer. Lower prices were opening a door that new models could no longer hold open without major support. A returned lease could offer similar range, technology, and daily driving costs for far less money, making the used side feel like the more honest version of the same product. One used EV could be profitable, while another became difficult to move. Battery health shaped buyer confidence, while charging speed affected daily use. A strong factory warranty could protect the next owner, but a weak auction bid could erase dealer margin before the car reached the lot. Software updates, winter range, repair access, and battery replacement costs could separate two vehicles that looked almost identical from the outside. Rapid discounts on new models made those values even harder to predict, because one factory rebate could weaken every similar used car already sitting in stock and change the dealer's expected profit overnight. The first break was not electric driving itself. Buyers still wanted used EVs when the price felt right. The pressure sat inside premium EVs, where large discounts weakened lease values and reduced future trade-ins. Manufacturers could keep selling cars, but not without giving up more money. Owner loyalty could not repair that price and profit problem waiting behind the next sale. One side of the market was growing because prices had fallen. The other was weakening because those same lower prices damaged margins, resale values, and the assumptions built into new car production. 96% of owners of newer battery electric vehicles said they would consider buying or leasing another one. J.D. Power recorded that result in its 2026 study, even while American new EV sales were falling. Owners pointed to better range, easier charging, stronger performance, and lower running costs. The number did not describe a product people wanted to abandon. It showed that drivers still liked newer BEVs, even as the business around them weakened across dealer lots during the first half of the year. 62% of returning franchise brand EV lessees chose another electric vehicle when their contracts ended in 2025. Across current owners, 94% said they would definitely or probably consider an EV next time. J.D. Power was seeing customers return, but the next deal still had to make financial sense across the franchise network. The buyers had not disappeared. 62% had stayed with electric driving, while many others refused to carry the full purchase price and future resale risk. 25% of new vehicle shoppers were very likely to consider an EV, according to the 2026 consideration study. Another 35% were somewhat likely, giving electric cars attention from 6 out of every 10 shoppers. J.D. Power was not measuring a market with no interest left. The problem appeared when interest reached the dealership and met charging access, insurance costs, home setup, and the monthly payment. 25% showed strong interest, but interest alone could not close the deal when full costs appeared. More than 20 million electric cars were sold worldwide in 2025, according to the IEA. Global sales rose about 20%, giving electric cars 1/4 of the market. EV Volumes expects combined battery electric and plug-in hybrid sales to grow another 7.8% in 2026, with pure battery models rising 17.2%. Outside America, demand was still expanding through the same period, making the United States slowdown look less like rejection of electric driving and more like a local price, incentive, and production problem. $11,000 of support on one vehicle showed where the pressure remained. J.D. Power estimated average EV incentives of $11,258 in March 2026, while sales stayed weak and manufacturers faced billions in charges inside company financial reports. Strong owner loyalty could not protect dealer margins, lease values, or trade-ins. Electric driving was not disappearing, but the American business built for faster adoption was breaking first. By summer 2026, factories were being redirected, contracts cancelled, and production plans reduced behind closed doors. A $1.6 billion charge appeared in GM results during Q3, followed by another $6 billion in the final quarter of 2025. The money covered damaged assets, cancelled contracts, supplier settlements, and the decision to end BrightDrop electric van production. These were not discounts placed on a few slow vehicles. They were costs tied to factories, equipment, and agreements built for demand that never arrived. General Motors was now spending billions to pull back from plans it had once expected to expand. The Orion assembly plant had been prepared for electric production. GM then moved it back toward ICE vehicles and told investors its 2026 losses would improve through right-sizing capacity and building significantly fewer EVs. The wording sounded controlled, but the decision was clear. Earlier plans had assumed buyers would arrive much faster. When they did not, factory space had to be redirected, production targets had to fall, and the company had to shape its electric business around a smaller market. Ford's electric division carried the same warning in its financial results. Model E lost $4.8 billion during 2025, even after improving by roughly $300 million from the year before. Ford expected another $4 billion to $4.5 billion loss in 2026. Gasoline vehicles, hybrids, trucks, and commercial operations were producing profit while the electric side continued consuming cash. The company could keep funding those losses for a time, but its own forecast showed that rapid growth was no longer expected to fix them quickly. Another 45,000 gasoline and hybrid F-150 trucks are planned for 2026. That move sits beside Ford's stronger focus on hybrids, extended-range EVs, smaller affordable battery vehicles, and energy storage. The company is not walking away from electrification. It is stepping back from depending on large, expensive first-generation EVs to carry the entire plan. Production is being shifted toward vehicles customers are buying now, while future electric models are being redesigned around lower prices, longer range, and less financial risk. Even Tesla, still holding roughly half of the American EV market, saw first-half sales fall more than 10%. Cox Automotive found that most manufacturers also posted weaker results in Q2 2026 and were reviewing products, factories, and investment plans. Dealers saw the retreat before many buyers did. Fewer allocations, changing model schedules, stronger incentives, and vehicles disappearing from future lineups. Factory decisions had finally caught up with the warning on dealer lots, leaving one final question about what was truly collapsing. A 53% drop arrived as soon as the federal credit disappeared. Q4 2025 volume then fell more than 36%, followed by another 27% decline in Q1 2026. Q2 remained down 20.5%. The fall had already moved through 4 straight stages, leaving more pressure on dealer lots before dealers had time to clear vehicles already ordered across the country that year. About 14% of the average transaction price was now being used as incentive support. New EV prices had fallen for nearly 12 months, yet buyers still needed $11,258 removed before signing. Cox Automotive showed the pattern clearly. The car could still sell, but the original price was no longer carrying the deal by itself. Margins weakened as every discount grew larger. Another 243,000 franchise EV leases are ending during 2026. Mannheim auction volume had risen by Q4 2025, while used EV sales grew faster than new sales. Those returns will arrive beside unsold new inventory with similar range for far less money. Dealers know one used vehicle can force a discount on the new one. That competition can pull prices down again. General Motors has taken billions in EV-related charges, while Ford Model E continues losing billions. GM is reducing planned volume, and Ford is shifting production toward F-150 trucks, hybrids, and extended-range vehicles during 2026. Factory decisions are now saying what dealer lots showed first. The earlier growth plan was too large for the demand that arrived before another quarter closed. The new EV sitting on an American dealer lot is where the break becomes clear. Supply once reached 149 days. The credit covered $7,500, and lease returns keep rising through 2026. Dealers see numbers before buyers connect them. Electric technology may survive, but the US market built around high prices is being dismantled before affordable replacements arrive and factory losses.